Namaste. In the year 2015, our government of India entered into an agreement with Reserve Bank of India. The agreement was called Monetary Policy Framework Agreement. Among many other things that this agreement provided, there was a concept of inflation targeting. It was provided that Reserve Bank of India, in consultation with the government of India, will set inflation target for the next 5 years of the economy. Accordingly, for the period ranging from 2016 to 2021, inflation target was set at 4%. This 4% is as per CPI, that is Consumer Price Index. It is not as per WPI, that is Wholesale Price Index.
While the Reserve Bank's stance will continue to be accommodative, the focus of monetary action for the near term will shift to working with the government to ensure that impediments to banks passing on the bulk of the cumulative.
But agreement provided that this was to be flexible inflation targeting, not fixed inflation targeting where you set one number as the inflation target. Here you had to provide a range as the inflation target, so you had to also provide for tolerance in that inflation target. For that period of 5 years, tolerance provided for was plus or minus 2%. That means RBI was mandated to keep inflation in the range of 2 to 6%. This target ended in the year 2021, so the target had to be reset. Again, for the next 5 years, target was set at 4%. Again, that range of 2 to 6% was made applicable. But what we are saying is, for the last many months, due to given uncertainties in the global market as well as domestic market, RBI has been consistently failing to keep inflation within that limit of 2 to 6%. In order to control inflation, if you see the figures of the last month, August 2022, our CPI was 7%, way above that limit of 6%. So in order to control inflation in that range of 2 to 6%, what RBI has been doing is, it has been consistently increasing the policy repo rate. Policy repo rate, simply put, repo rate.
The MPC decided to increase the policy repo rate by 50 basis points to 5.9% and to remain focused on withdrawal of accommodation while supporting growth.
Again, in its monetary policy review, it has raised repo rate from 5.40% to 5.90%. That is the increase of 50 basis points. What would it result into? It is the interest rate at which banks borrow money from Reserve Bank of India, means now it will become costlier for the banks to borrow money from RBI. If it becomes costlier for them to borrow money from RBI, they are going to make it costlier for us to borrow money from them. Right now? Means we shall be borrowing less money from the banks, we shall be having less money in the hands, we shall create less demands in the market. That will automatically bring down inflation. What RBI has hoped is, in the 2-year cycle, it will be able to control inflation at the rate of 4%. Let's hope for the best.